In today's world, the landscape of finance and wealth preservation is evolving at a pace unlike anything we've seen before. The old rules no longer suffice. Placing your trust entirely in a single form of money, no matter how dominant it seems today, exposes you to risks that can quietly accumulate and suddenly disrupt your financial future. We live in an era defined by rapid innovation, shifting policies, and global interconnections, and the implications for currency are profound. The reality is simple: resilience comes from flexibility, and flexibility comes from spreading your exposure across different stores of value. When you look at history, no currency has ever remained supreme indefinitely. Even those once considered unshakable eventually faced periods of devaluation or disruption. The world is dynamic, and so too must be the strategies we adopt to protect and grow our capital. By diversifying the ways you hold wealth, allocating across multiple forms of value rather than relying on one, you create a hedge against unforeseen shocks. This is not speculation, it is strategy rooted in understanding cycles and long-term trends. The mindset to embrace here is one of opportunity and foresight. Each form of value has unique characteristics, advantages, and limitations. Some are highly liquid, some preserve purchasing power over decades, and others act as insurance against systemic risk. By thoughtfully balancing these, you are not only protecting your wealth, but positioning yourself to benefit from global shifts. Innovation, geopolitics, and policy changes can move markets in ways that defy short-term prediction. But a well-diversified approach allows you to participate in growth while mitigating downside. Furthermore, relying on a single currency often limits your perspective. It narrows the lens through which you view global trends and innovations. Those who embrace multiple avenues of value develop a more nuanced understanding of the forces shaping our financial future. They see beyond volatility in headlines, focusing on long-term adoption, transformative technologies, and structural shifts in the economy. This is where true growth resides, not in chasing quick wins, but in positioning for the compounding effects of patience and insight. In essence, spreading exposure across multiple forms of value is an acknowledgement of the uncertainty inherent in global finance, and a proactive embrace of opportunity. It's about thinking decades ahead, understanding that resilience and growth are inseparable, and recognizing that adaptability is not just a defensive strategy, it's a pathway to transformative outcomes. Those who internalize this principle are not merely weathering the future, they are shaping it. In a world increasingly dominated by digital promises and abstract valuations, there is a timeless principle that remains critical: owning what is tangible, what has intrinsic value, what cannot simply vanish overnight. Real assets, whether physical infrastructure, productive enterprises, or things that generate value in the real economy, represent a foundation upon which wealth can be preserved and amplified over decades. The allure of fleeting trends and paper constructs can be seductive, but those who anchor themselves in the tangible understand that true transformation and long-term growth flow from things that actually produce. The modern economy is moving faster than ever. Technology is creating exponential growth in sectors that were unimaginable just decades ago. But even in this age of innovation, the most resilient paths are those grounded in reality. Assets that serve human needs, facilitate trade, or provide essential services are not just instruments of security. They are engines of growth. They are the infrastructure of progress, and by owning them, one positions oneself to benefit from both the evolution of society and the expansion of economic activity. Investing in real things also instills a mindset of patience and insight. Unlike ephemeral trends, tangible assets require careful understanding of underlying value, operational capacity, and long-term utility. Those who engage with them are forced to think in decades, to anticipate adoption cycles, and to appreciate how innovation and infrastructure intersect. The payoff is not merely financial, it is strategic, providing both security and leverage as the world changes. By contrast, relying solely on abstract promises or untested instruments exposes one to volatility and uncertainty that often comes when hype meets reality. Moreover, real assets have a unique ability to anchor portfolios during times of turbulence. Markets can swing wildly, policies can shift unexpectedly, and confidence in intangible constructs can evaporate overnight. Yet tangible holdings, productive businesses, essential commodities, or infrastructure retain inherent worth because they exist in the world as functional entities. They meet real demand, solve real problems, and generate value irrespective of sentiment. For the patient, disciplined investor, this provides both resilience and an unparalleled opportunity for compounding growth over time. Ultimately, embracing real assets is about aligning with the forces that drive the future. It is a commitment to understanding the engines of human progress and positioning oneself where value creation is unavoidable. It is not simply a defensive posture, it is an offensive strategy for capturing the long-term benefits of innovation, societal adoption, and global economic expansion. Those who recognize this are not reacting to volatility, they are participating in transformation. They are not speculating, they are building. By owning real things, one ensures that wealth is not only preserved but amplified. It becomes a bridge between vision and reality, between patience and growth, between innovation and enduring value. In this approach, opportunity and security are inseparable, and those who embrace it are well positioned to thrive in the decades ahead. In a world defined by rapid change, uncertainty, and exponential technological advancement, the concept of protection takes on a new meaning. Protection is not about avoiding risk entirely. It is about positioning oneself to benefit from growth while mitigating the unexpected. The most effective way to achieve this is through diversification, spreading exposure across multiple avenues of value rather than relying on a single path. By doing so, investors embrace resilience, adaptability, and the ability to participate in transformative trends while limiting vulnerability. Diversification is not simply a defensive measure, it is a strategic framework for capturing opportunity. Each avenue of value, whether in physical assets, innovative enterprises, or emerging technologies, offers distinct characteristics and growth potential. By allocating thoughtfully, one can participate in multiple growth trajectories simultaneously, creating a balance that preserves capital while amplifying long-term returns. It is not about chasing every trend or predicting every outcome. It is about understanding structural shifts and positioning to benefit regardless of how individual events unfold. The world is interconnected, and shocks can reverberate across economies in ways that defy prediction. A concentrated approach exposes one to sudden and sometimes irreversible setbacks. Diversification, on the other hand, allows for resilience in the face of volatility. It is the recognition that innovation does not occur in isolation, and that the most powerful returns often emerge from a constellation of complementary forces, rather than a single source. Those who embrace this principle are not merely avoiding risk, they are constructing a foundation for sustainable growth. Moreover, diversification fosters clarity and insight. By observing multiple sectors, technologies, and value drivers, investors gain a broader perspective on where progress is occurring and how trends interact. This knowledge enables more informed decisions and a deeper understanding of long-term adoption cycles. It encourages patience and a commitment to the journey of compounding, rather than the fleeting allure of immediate gains. The payoff is both strategic and financial. Protection becomes a pathway to opportunity. Ultimately, diversification is about embracing the future with confidence. It is an acknowledgement that the world will continue to evolve in unpredictable ways, and that success comes from flexibility, insight, and foresight. It is a principle that aligns with innovation, resilience, and growth, allowing those who adhere to it to navigate uncertainty with conviction. Those who recognize this are not merely reacting to change, they are positioning themselves to thrive as change unfolds. By spreading exposure thoughtfully, one creates a portfolio that is both protective and growth-oriented, resilient to shocks yet poised for the transformative power of long-term trends. Diversification is not a compromise, it is an enabler. It turns uncertainty into opportunity, volatility into advantage, and patience into compounding growth. In embracing this principle, one aligns with the forces that shape the future, ensuring that protection and progress move hand in hand. When we look at the world through the lens of decades rather than days, months, or even years, an entirely different perspective emerges. Markets, technologies, and societies move in cycles, some short, some extraordinarily long, but the patterns are undeniable. Those who align their thinking with long-term cycles gain clarity, resilience, and the ability to capture transformative opportunities that others overlook. It is not merely a strategy, it is a mindset, a commitment to seeing the horizon and understanding that real change unfolds over time. The first principle of long-term thinking is patience. In a world obsessed with quarterly results and immediate gratification, it is easy to lose sight of the bigger picture. True value creation rarely occurs in a straight line. Breakthrough technologies, new industries, and paradigm-shifting business models often take years, even decades, to reach maturity. Early adoption may seem uncertain, and volatility can be intimidating, but history has repeatedly shown that those who commit to the full cycle of innovation are the ones who benefit most profoundly. Long-term cycles also reveal the exponential nature of innovation. Small advances compound, adoption accelerates, and what once seemed niche or speculative can become ubiquitous. Think about the patterns in computing, energy, communication, and biotechnology. Each breakthrough builds upon previous progress, and the pace of transformation is increasing. Investors who understand this are not swayed by short-term noise. They see the structural forces that drive growth over decades and position themselves to participate fully. Another key insight is that cycles are interconnected. Economic, technological, and societal shifts rarely occur in isolation. Policy changes, demographic trends, and global adoption patterns influence each other in ways that create powerful feedback loops. Recognizing these connections allows one to anticipate opportunities and manage risk more effectively. It is not about perfect prediction. It is about understanding the dynamics of change and positioning oneself where the momentum is likely to build over time. Thinking in cycles also reframes the concept of risk. What might appear as volatility in the short term can be an essential part of the long-term growth trajectory. Companies and sectors experience fluctuations, corrections, and periods of uncertainty, but these are often the moments when innovation is solidifying its foundations. Those who focus on long-term cycles understand that temporary setbacks are not failures, they are part of the natural progression of transformation, offering entry points for those with conviction. Moreover, adopting a long-term perspective encourages a focus on value creation rather than speculation. When time horizons extend to decades, the fundamental drivers of growth, productivity, adoption, scalability, and societal impact become paramount. Investors who align with these forces can harness compounding in its most powerful form, participating in the structural evolution of industries rather than chasing fleeting trends. The payoff is not only financial, it is strategic, providing insight, foresight, and influence over emerging opportunities. Ultimately, thinking in long-term cycles is a discipline, a philosophy, and a way of navigating a rapidly changing world. It requires curiosity, conviction, and courage. It demands the ability to look beyond daily headlines, short-term noise, and temporary disruptions, and to focus on the transformative trends shaping the future. Those who embrace this mindset are not merely surviving the cycles, they are thriving within them, positioning themselves to capture the outsized returns that only patience, insight, and strategic vision can deliver. By understanding the rhythm of innovation, the compounding effects of adoption, and the interconnectedness of societal and technological trends, one gains a roadmap for growth that transcends the limits of conventional thinking. Long-term cycles provide clarity in uncertainty, opportunity in volatility, and resilience in change. They remind us that progress is rarely instantaneous, that real transformation requires time, and that those who align themselves with the full arc of change are the ones who will shape the future. Embracing long-term cycles is, in essence, embracing the future itself. It is a commitment to vision over impulse, strategy over speculation, and enduring value over fleeting trends. It is a recognition that the greatest rewards belong to those who see beyond the present, who understand that patience compounds into opportunity, and who position themselves at the intersection of innovation and time. In this approach, the world is not a series of random events, it is a landscape of cycles, each offering the potential for profound growth to those with the foresight and courage to stay the course.